the SEC, Chairman Shapiro has urged all of us to learn from that experience and reform the way we operate. Over the past year, we've taken significant steps in that regard, reinvigorating the Enforcement Division, enhancing our inspections, bolstering our training program, revamping our tips and complaints process, and hiring personnel with new skill sets. And we will continue to reform. With regard to the Madoff liquidation, the Commission and its staff have been analyzing SIPA, its legislative history, and case law to determine how to properly value the claims of the investors. While claims for losses suffered by investors are determined under SIPA, the statute does not expressly address how to address the net equity in a customer's account when a broker-dealer has engaged in the sort of fraudulent scheme Madoff perpetrated. As a result, the bankruptcy court will soon hear arguments on the various theories proposed for valuing customer claims. In the end, the court will decide how the investor's claims should be valued. The Madoff liquidation raises a new question. Specifically, how does SIPA apply when a customer's brokerage statements show non-existent positions in real securities that the broker concocted after the fact to support predetermined fictional investment returns? Two primary approaches have been proposed. The first is known as the final account statement method. Under this method, the net equity in customer accounts would be based on the securities positions shown on the final account statements customers received before the firm was placed in liquidation. The second principal approach is the cash-in, cash-out method. Under this approach, net equity is determined by crediting the amount of cash the customer deposited in the account and subtracting any amounts withdrawn from the account. Based on our analysis, the Commission will recommend to the Bankruptcy Court that customer claims in this case should be determined through the cash-in, cash-out method advocated by the trustee and SIPC. However, we believe that the amount should be adjusted to constant dollars to ensure that investors' claims in this long-running scheme are valued most accurately and fairly. The Commission decided not to recommend the final account statement method on the facts of this case because it believed it would result in claims based on account balances that Madoff himself concocted and that bore no relation to reality. Madoff essentially promised customers that he would pick winning stocks for them, did not tell them which stocks he would purchase, waited to see which stocks did well, and then falsely reported that he selected stocks that met their investment expectations. Through no fault of investors, the account statements Madoff sent were illegitimate tallies of a fraudulent scheme. Neither SIPA nor any of the cases interpreting it can be read to support an approach that would value claims based on the fictitious investment returns of such a scheme. As a result, the Commission has concluded that the fairest and most reasonable way to measure the value of the Madoff customer's net equity is to look to the money those customers invested with Madoff as a proxy for the unspecified investments in securities Madoff told them he would make for their accounts. To do otherwise would have the effect of favoring early investors, many of whom withdrew all or more than the principal they invested with Madoff, over later investors, some of whom will not receive a distribution equal even to their principal. At the same time, the Commission is sensitive to fairness concerns raised by the cash-in, cash-out method. That method favors later customers at the expense of earlier customers by treating a dollar invested in 1987 as having the same value as a dollar invested in 2007. In our view, it is appropriate to convert the dollars invested into constant dollars. We believe that approach, rooted in the economic concept of time value of money, will result in greater fairness across different generations of Madoff investors, in effect treating early and later investors alike in terms of the real economic value of their investments. The Commission understands that the total pool of money available to distribute claimants is limited, and that there will not be enough to compensate all victims. That means that money allocated to one Madoff victim will affect the amount of money available to compensate other victims. The Bankruptcy Court's task, and the Commission's goal in making its recommendation, is to arrive at the fairest way, consistent with the law, of dividing that limited pool. I thank you again for the opportunity to appear before you today, and would be pleased to answer any questions you may have.
Thank you very much, Mr. Conley. And next, we will hear from Steve Harbeck, President and Chief Executive Officer of the Securities Investor Protection Corporation. Mr. Harbeck.
Thank you, Mr. Chairman. Chairman Kanjorski, Ranking Member Garrett, members of the committee, Thank you for giving me an opportunity to discuss SIPC's work over the last year and to discuss possible amendments to the Securities and Investor Protection Act. My name is Stephen Harbeck. I've worked at SIPC for 34 years, and I became president in 2003. SIPC has no role in the investigation or regulation of brokerage firms. That duty falls to the SEC and the self-regulators. When SIPC is informed that a brokerage firm has failed, we institute a customer protection proceeding in district court and then refer it to the bankruptcy court. Customers of brokerage firms are protected within statutory limits. The first such source of protection is a prorated distribution of customer property. As Professor Coffey noted this morning, that makes it a zero-sum game. SIPC can supplement customer property by as much as $500,000 per customer with a limit of $100,000 for cash. SIPC has overseen the return of approximately $160 billion to customers and has advanced more than $323 million prior to the Madoff case to do so. About 11 months ago, I appeared before you to report on the two largest brokerage firm failures in history, Lehman Brothers and Madoff. I would refer you to my written comments for progress with respect to Lehman Brothers, which I think is substantial. In the Madoff case, unlike the Lehman case, a transfer of accounts was simply impossible. Through the claims process, the following is the status of the claims. The trustee is allowed $4.6 billion worth of claims. That represents returns to 1,600 claimants. SIPC has committed and has advanced most of $559 million. This is more than in all previous SIPC liquidation proceedings combined in the past. There have been 16,000 claims filed, and there have been 11,500 claims determined, or 71% of the claims. The trustee has thus far collected $1.1 billion, and he's filed 14 lawsuits seeking the return of $14.8 billion, and we will discuss that again in just a moment. The subcommittee has asked specifically for information on the fees in this case. As you heard this morning, the trustee has been paid $1.275 million, and the law firm of Baker & Hostetler has received $37.5 million. I remind you that this is the largest Ponzi scheme in history, and most of the trustees and legal fees efforts that are being expended here are for the purpose of recovering assets. In terms of the legislative initiatives that are before you, SIPC has proposed a number of amendments to SIPC, and these include increasing the amount that SIPC can advance for claims for cash to $250,000 and to index that dollar figure to inflation by a specific formula. We would increase SIPC's line of credit with the Treasury from $1 billion, where it's been since 1970, to $2.5 billion. We would increase the number of cases where SIPC can use a streamlined procedure. And I would suggest to you that the members of this morning's panel should agree with all of those changes. But there are other proposals that I must address. One is extended coverage for participants in pension funds, which was extensively discussed this morning. On a going-forward basis, this certainly deserves study. However, the proposal lacks any analysis in terms of risk management or possible cost to either SIPC or the Treasury. And as both the chairman and the ranking member implied this morning, it is imprudent to enact a measure without that analysis and knowing that what it will cost as a possible drain on the Treasury. SIPC cannot take a position on this without the appropriate due diligence, and my written statement contains a great deal more on that issue. SIPC is a complex law, but the pension fund issue shows that the current state of the law is somewhat in accord with common sense. If you have an account and you can call your broker and make a purchase or trade and get a statement, you're a customer. Granted, the statute was drafted in a simpler time when that was the standard, but that is still the law. In terms of extended coverage for other indirect claimants, one of this morning's panel members testified that he's an indirect victim, and he certainly is. But I think I have to elaborate. He placed his money with a hedge fund, which invested in another hedge fund, which invested in another hedge fund, which invested in Madoff. Again, as Professor Coffey said, it would be very, very difficult to craft legislation that would cover that situation and expand the coverage of the statutes beyond what was ever intended to be. Now I'd like to address a point that I feel personally very strongly about, and that is depriving a trustee in prospective legislation of the right to recover preferences and fraudulent transfers in certain instances. Ms. Chaitman testified about this issue. Mr. Chairman and members of the subcommittee, I cannot urge you strongly enough to reject this amendment. If enacted, it would deprive the victims Ms. Chaitman represents of literally millions of dollars. Mr. Coffey noted that this morning, and he is absolutely correct in that regard. The Madoff trustee has used the avoiding powers granted him by SIPA and the Bankruptcy Code judiciously. He has not sued small investors. He's sued 14 large investors. He has urged any Madoff customer who has received more money than he placed with Mr. Madoff to open discussions with him. And he is open to reason. This is a man who is extraordinarily practical. He served as a trustee in more of these cases than any other human being ever. He's instituted preference and fraudulent transfer proceedings against large investors who receive disproportionate returns. But the weapons in the trustee's arsenal include the fact that all he must prove is disparate return without any issue of legitimate expectation arising. Ms. Chaitman's written statement at page 17 says that the trustee in Madoff has already sued several elderly, virtually destitute investors. Ms. Chaitman is a vigorous advocate, but she's factually incorrect. The only situation in the Madoff case where small investors have been sued were 3 instances where the claimants ignored the claims filing procedure that has been in place for 39 years and initiated a lawsuit against the trustee. In short, the trustee was required to institute mandatory counterclaims, and those are the only small investors who have been sued. In short, the proposed legislation addresses a problem which has not arisen, will not arise in this case or any other, and would do extensive damage to the very people it seeks to help. Indeed, it would actually encourage Ponzi schemes in a real sense, because it would allow people to be free of the prospect of what you have heard today called clawback and what are more accurately described as congressionally mandated equitable distributions. It would deprive the trustee of the ability to get money back from someone who has gotten all of their money back, someone who has kept stolen money from others, and who will share in that common pool of assets at the direct expense of other people who have not gotten all their money back. That is wrong. It's a matter of both law and policy. In the written questions submitted by the subcommittee, you have asked if extending SIPC coverage to the victims in situations such as the Stanford Financial Group makes sense. And there is legislation to deal with that situation. SIPC protects the custody function that brokerage firms perform, and in the Stanford case, investor assets were not located at the SIPC member firm. Instead, in the Stanford case, investors sent money at their own request to a bank in Antigua. The bank issued certificates of deposit. The investors have physical possession of those CDs, and the bank defaulted due to fraud. These investors are not covered by SIPC. I do not believe the subcommittee should make the SIPC fund and the United States Treasury the insurer of the underlying value of any security, and I don't believe the subcommittee wants the United States Treasury to guarantee the debts of an offshore bank. Retroactive application of any of those amendments, particularly with respect to the Madoff case, would change the advantage from one group to another in a completely arbitrary way. For the reasons given in my written statement, any amendments, should you consider them, should be prospective. I'd like to address Mr. Conley's mention of the constant dollar theory. The first time SIPC was presented with this theory was November 23rd. The concept simply isn't in the statute. Congress knows how to write a law in constant dollars, and in fact we have in our amendments asked for an index to inflation with respect to the cash protection under our statute. It creates arbitrary results, different arbitrary results from the ones that the statute now has. The consequences for your constituents are that if you backed a concept of constant dollars, you would have to say that a person who received all his money back and who received stolen money will get even more at the direct expense of people who have not been made whole. In a limited sample of about 2,000 of those accounts, we located in New York 138 people who would receive net, given what we expect the trustee to recover,